Welcome to a new season of Fundamentals of Accounting series. We're going to discuss details regarding the share capital and its related transactions which the beginners of accounting needs to understand to able to undertake further research, further studies regarding journal entries and balance sheet transactions. Equity share, or which is commonly referred to as the common stocks, is a particular class of stock which is defined as the ownership stock. Every registered company must have one class of stock which is the ownership stock. The ownership stock is known as common stock. One of the most important characteristics of the common stock which has been issued and held by the common stockholders is that there is no guaranteed dividends provided on the common stock. This is because dividend cannot be paid unless the directors of the company think so, even if the company has profit. So the payment of dividend on common stocks to the shareholders depends entirely upon the decision undertaken by the directors of the firm. Further, those who hold the common stock or the common stockholders or equity stockholders would have control of the management of the company. This means those shareholders who hold a majority share in a company would be able to appoint majority directors in the board of directors and therefore having control of the overall management of the firm. Common stock is also known as the residual stock, residual corporate interest. In case of liquidation, for example, liquidation means when the directors think or are of the opinion that the company is not in a position to undertake further business and it's not in the interest of the shareholders to undertake business further. So the company has to be stopped from doing further business, that is known as liquidation. So in case of liquidation of the stock of the firm, rather, first of all, the creditors and the preference shareholders will be paid, and whatever remains, the residual corporate interest after payment of creditors, bondholders and preference shareholders, whatever remains, the residual, would be paid to the common stock. Let's go to the next slide. You need to understand various categories, forms of equity that is generally issued by a company. First of all, the corporate charter of a business which has been registered as a company or incorporated would mention authorized share capital. This is the maximum number of shares that can be issued to the public for subscription. So the amount of the authorized share capital is fixed and the firm is registered with that legally. So a firm in general cannot be able to issue more than what is authorized in the corporate charter. The second is issued share capital. If a firm has an authorized share capital, then issued capital can be up to a maximum of that. But generally, the firm at a time doesn't issue all those authorized share capital. So issued share capital are those number of shares which has actually been issued and generally lower than authorized share capital. The number of issued share capital is generally less than what is authorized. But if the authorized share capital is fully issued by the firm's management, then the issued share capital can be equal to authorized share capital. We'll see the example in the next slide. Now let's come to the next form of the share capital, which is known as subscribed capital. Subscribed share capital is that part of that number of shares which has been subscribed for purchase by the shareholders or by the investors. So the subscribed capital is generally lower than issued capital, but it can be equal to issued capital if the total amount of issued share capital is fully subscribed. So generally, it's not mandatory that issued capital is fully subscribed by the public. Sometimes all of the shares might not be fully subscribed. So in that case, if the shareholders or the investor has not shown interest to buy all the shares that has been offered for subscription, then the subscribed capital will be lower than issued capital. The next is paid in capital or paid up capital. Paid up capital is that part of subscribed capital which has been actually paid by the shareholders. And it's not mandatory that all the amounts which has been called by the firm's directors upon the issue of shares and subscription of shares are paid by the shareholders. So some part of the shares that has been issued to the public might not be fully paid. So paid in capital can be less than subscribed capital. Let's see one example of all the four forms of equity. Authorized capital. Let's take the example of MNC Limited, which has been registered with a maximum of 10 million shares of the value of 10 each. So this means MNC Limited would be allowed to offer a maximum of 10 million stocks to the public at a price of rupees 10 each. The price is known as par value. Par value can be defined as a price which has been set in the corporate charter. The price the shareholders can be asked to pay a par value of 15, 2, 5 or even $100. The charter decides what should be the par value of the stock. So if the firm is allowed to issue a maximum of 10 million shares of 10 each, then the authorized capital would be $100 million. That is $10 million at the rate of 10 each. Under no circumstances, MNC Limited will be allowed to issue more than 100 million share capital to the public. So let's come to the issued capital. For example, say that MNC Limited's board of directors decides to issue only 50% of the above 10 million stocks. So they decide to issue only half of the total authorized share capital, that is 5 million shares or stocks of 10 each. So in that case, the total amount of issued capital for MNC is 50 million, which is 5 million multiplied by 10. So you can see in this case, authorized capital is 100 million, but issued capital is 50 million only. This means the board of directors decided that all of the shares authorized are not required to be issued. They can issue. If they issue all the shares, then issued capital would be equal to authorized capital. Let's come to the next slide, which discusses the subscribed capital and paid up capital. We have seen that the authorized capital is 100 million, that is 10 million stocks of 10 each, and issued capital is 5 million stocks of 10 each. But subscription has been received for 4 million stocks at the rate of 10 each. So public or the investors are not interested in subscribing or buying fully the 5 million stocks that has been issued. They have shown interest to buy 4 million stocks at 10 each. So subscribed capital is 40 million. 4 million stocks of 10 each. Remaining 1 million stocks are not sold because they were not takers or investors who are not interested in purchasing those stocks. So subscribed capital is only 40 million while the issued shares capital was 50 million. Further, the investors has 40 million to pay for purchasing 4 million stocks of 10 each. But if the investors has paid only 8 each instead of 10 each, rupees 2 is still to be paid. That means investors has paid a total of $32 million, which is 4 million stocks at the rate of 8 each. So the paid up capital or paid in capital is 32 millions, whereas subscribed capital was $40 million. The remaining 2 each can be called up by the board of directors for the investors to be paid within a time frame as and when they feel that the capital or the money is required to be invested in the business for undertaking general business, to expand the business, to do day-to-day operations of the business. So we have seen the forms of equity capital that you should know. Now let's go to the next slide, which is preferred stock. Equity stock is the ownership stock, but preferred stock is a separate class of shares with a preferential feature which is not possessed by common stock. So this means preference shareholders have certain characteristics different from the equity stock. For example, the preferred stock has preferred dividends. Dividend fee on preferred stocks should be paid annually and before any equity dividend has been paid. In case of liquidation, as and when the business will be closed, preferred stock holders will be paid before the equity shareholders are paid. The preference shareholders are preferred for repayment of their capital in case of liquidation. If the preferred stock issue has been defined to be convertible preferred stock, then the preferred stocks can be converted into common stocks only if it has been agreed and the preferred stockholders agree to convert their stock into common stock. They can also be redeemed before they expire. Redeemed means redemption. Redemption means the preferred shareholders can be repaid and the preferred stocks can be bought back by the issuing company as and when they prefer it to be. Preferred stocks are non-voting. They cannot vote on any resolution passed by the company, whereas you must remember that equity shareholders has every right to vote on every resolution which decides to, for example, appoint directors, undertake expansion, undertake a new form of business, issue new shares, and etc. So preference shareholders doesn't have any right to vote on any resolution being considered by the company. Preference shares can either be cumulative or they are convertible. Convertible, as I have already said, in some cases preferred stocks can be converted back into equity shares by the issuing company only if the preferred stockholders so agree. So these are known as convertible preferred stock. Cumulative preferred stock means if in any particular year the company is not able to pay dividend on those shares because there is generally not sufficient profit made by the firm, then in the latter year, in the next year, the company would have to pay current year's dividend plus last year's dividend. So in case of cumulative preferred stock, in 1 year, in year 1, the company is not able to pay the dividend. In year 2, the company has to pay dividend for year 1 plus dividend for year 2. Cumulative preferred stock. The dividend would be cumulated. Dividend will not be forfeited by the company at any cost. Now, this is a financial concept. If you are studying finance and or ratio analysis, you should know what is earning per share is, EPS. This is very much interesting to investors, shareholders. They're very much interested in knowing how much profit a company makes. How much profit a company makes per share. Earning per share is the profit after tax made per share by a company in a particular year. So the EPS is calculated as net profit after tax divided by number of common shares outstanding. So for example, if MNC Limited has a net profit after tax is known as PAT of 50 million and the number of outstanding stock is 50 million. As we have seen earlier, the company issued 50 million stocks, 50 million profit is also there in year 1. Then EPS, earning per share, is $50 million divided by 50 million, which is the number of stocks, is equal to $1. So this means for every single share issued by the firm has earned a profit of $1 per share. The larger the EPS, the better it is. So EPS should be larger is preferred. Because of that, the shareholders always want the EPS to grow. Whatever EPS is generated in current year, for example, $1 per share, they want to grow it, suppose at 5% or 4% per year. So next year, the shareholders want the EPS to be 1.04 or 1.05. Example of EPS and preference dividend. Here we should see how EPS and preference dividend and tax is calculated. For example, the question says that MNC Limited has a net profit before tax or PBT, profit before tax, of 50 million. Outstanding stock is 50 million. They have 10 million preference shares of 10% each. This means preference dividend should be 10%. And stock is issued, preferred stock is issued at 50 each. The company is under the tax slab of 30%. How should we calculate EPS? We take the EBT, earning before tax, 50 million. Tax will be calculated on EBT at 30%, so 15 million, 30% of $50 million. When you subtract 50 million minus 15 million, you get the PAT, profit after tax, earning before tax, or you can call it PBT. PBT less tax is PAT. PAT is 35 million. Less preference dividend is 5 million. That is 10% into 1 million shares. Each share is 50. So total preferred stock issued is 50 million. You pay a dividend of 10% as agreed at the time of issue. This is agreed 10% preference stock. So 10% dividend is preferred stock you have to pay. So preferred stocks, 10% of 50 million comes to 5 million. So profit balance after payment of preference dividend, 35 million minus 5 million is 30 million. This is 35, not 50. So profit balance is 30. Number of stocks issued, equity stock, is 50 million. No dollars. So 30 million divided by 50 million is 0.6. $0.6 is profit per share, which is known as EPS. Earning per share is PAT by N. So for this year, for the current year, MNC Limited is able to generate $0.6, 60 cents per share for each of the shares common stock issued to the investors. Stockholders' equity. Stockholders' equity is known as the equity shareholders fund, the common stock shareholders fund. It has three parts: the capital stock, equity share capital, which has been provided by the shareholders, additional paid in capital, which is premium. That means if a stock has been issued at $11 per share by the firm against the par value of 10, which we have seen in case of MNC Limited, you can say that the company is paying a premium of, company is taking a premium of $1 from the shareholders for each share. So for every share, the company is issuing the shares at a premium of $1. So paid in capital in excess of par means whatever excess the shareholder is paying to purchase the share in excess of the par. So MNC Limited is issuing the stock at 10 par value, but if the shareholder has to pay 11, then one shareholder for each share pays $1 in excess. So that is additional paid in capital, which is also known as security premium. Fine. If the MNC Limited stockholders has undertaken 50 million shares, then premium, security premium would be total of $50 million. Retained earnings. Retained earnings represents the earned capital. Emphasis on earned capital, not paid in or paid up. This is because this part of equity, which is known as retained earnings or RE, is not paid by the shareholders. It's the profit of the firm which has not been paid as dividend. So this means, as we have seen, that MNC Limited making 30 million profit in the last uh, slide, but it might not pay all the profits as dividends. So out of 30 million PAT, if it pays till 10 million as dividend, then 20 million is retained by the firm. So in that case, if PAT is $30 million less payment of 10 million in dividend, then there would be a RE of 20 million. This is dividend, right? So this means generally all the profits are not paid by dividend or in the form of dividend. So out of the profit after tax, whatever dividend is paid, if you subtract it, the balance will be retained profit, retained earnings. That is why it is known as earned capital. It has been earned as profit by the capital and kept as reserves. Issuance of stock. We have already discussed that the par value is what is being defined in the charter. We have seen that MNC Limited was issuing shares for 10 each par. So par value is 10. So MNC values par value of each stock is 10. But this 10 rupees stock can be issued at a higher price or a lower price. If the stock is issued at a lower price, less than par for 9, then the discount is 1. So if a 10 par value stock is issued at 9, it is issued at discount. The company decides what price the stock has to be issued to the shareholders. We cannot define how much should be the discount, what should be the par value. Instead of 10, the company can keep the par value at 100. Fine. So discount paid shares are shares which has been issued at a price which is lower than the par value. If the par value is 100 and a stock is priced at 90 rupees has to be paid by the shareholder, then in that case the stock has been issued at a discount of 10 each. Similarly, a stock can be issued at 11 in place of par value of 10. So 1 rupee premium, the shareholder has to pay $1 extra. In excess of the par. So this extra is known as premium. This means the stock has been issued at a premium and the whole amount which has been received as premium by the company is known as security premium. Fine. So stock can be issued either at par or at a discount or at a premium. So generally, you can see that if the share market is down, not much demand for stocks of new issues, stocks can be issued at a discount. If the share market is bullish, there is a lot of demand for particular shares, stock can be issued at a premium. If it is so-so, it's neither bullish nor bearish, par value is most preferred. You can subscribe to the channel. Please subscribe and thank you so much for bearing with me. I hope you have learned a few things from today's video and please subscribe. Very soon we will meet you again with a new learning video. Till then, thank you and bye-bye.